Today, are we there yet? Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 8th of December 2018. Our digest of the latest finance and property news with a distinctively Australian flavour. The financial markets continue to spin lower as the property sector here weakens, and the RBA confirms that it's quite willing to cut the cash rate if needs be, or even consider quantitative easing to support the economy. So, today we look at the latest tranche of data, which continues to point towards a weaker economy, whilst in a parallel world, Canberra continues to celebrate the strength of the economy thanks to their careful management, which raises the question, are we there yet? And by the way, if you value the content we produce, please consider supporting our efforts. You can make a one-off donation via PayPal, or consider joining our Patreon program. Here are the links. We really appreciate those who are contributing to help us continue to make great content. And the links are also in the comments below. We start with the national accounts data. The RBA was forecasting an annual GDP result of around 3.5% to December 2018, based on the recent statement on monetary policy. With the first 3 quarters of the year reaching just 2.2%, it would require a December quarter of 1.3%, which seems unlikely. So they will need to adjust their forecast down. All this looks to signal RBA cash rates will be cut ahead. And in addition, the per capita data went negative in September at minus 0.1%, meaning that it is population growth alone that is responsible for lifting the GDP. The per capita income and savings ratios were also negative, with the savings ratio back to lows not seen since 2007, as people dip into reserves to maintain lifestyle and pay the bills, as expected, given our household financial confidence index data. And net disposable income per capita fell 0.3% in the last quarter. Had it not been for strong commodity prices and big public spending on infrastructure, the story would have been a whole lot worse. And you can see more in our post Households Break the GDP. In fact, the RBA is positioning to cut rates and even apply quantitative easing if needed, as outlined in a speech on Thursday by Deputy Governor Guy Debelle. This would inflate the debt balloon further, and economist John Adams and I discussed this in a show we released yesterday, Unbounded Recklessness. The RBA has lost the plot. The RBA also said that what constituted too much debt was yet to be determined. Now, as you know, we think that current levels are already too high. In fact, the killer was the rise in our net foreign debt liability, which rose $12.6 billion to $1.044 billion in September 2018, another record. And remember, some of this, say 1/3, is short-term, meaning it needs to be continually refreshed. This is where our exposure is to rising interest rates. And we already know that the US will continue to hike rates, at least to some extent. The 1-year LIBOR rate, for example, is rising still, as is the BBSW. And this foreshadows real issues ahead. The debt bomb is alive and well. The RBA held the cash rate again this month, and there was little to report in their comments other than they seemed to be a little more cautious, suggesting that growth in China has slowed a little, that credit spreads are higher, and they say that one continuing source of uncertainty is the outlook for household consumption. Growth in household income remains low, debt levels are high, and some asset prices have declined. And the drought has also led to difficult conditions in parts of the farm sector. Then retail turnover was pretty anemic, According to the latest ABS data, the trend estimate rose 0.2% in October 2018, and this follows a rise of 0.2% in September and August. The following states and territories rose in trend terms in October: Victoria up 0.4%, Queensland 0.5%, South Australia 0.3%, Tasmania 0.3%, and the Australian Capital Territory 0.2%. Western Australia was relatively unchanged, while New South Wales fell 0.1% and the Northern Territory fell 0.8%. Online retail turnover contributed 5.9% in total retail turnover in original terms in October, and that's a rise from 5.6% in September and was the highest level recorded in the series. Then we got the dwelling approvals, which fell by 1.1% in October 2018 in trend terms, according to data released by the ABS. And the value of new residential building approvals fell 1.5% in October and has fallen for 10 months. More signs of pressure on the residential construction sector. Among the states and territories, dwelling approvals fell in October in the Northern Territory at 12.5%, South Australia at 5%, Western Australia at 4.4%, Queensland at 2.9% and New South Wales at 2.3%. Victoria saw a rise of 2.4% and the ACT of 0.8%, and they were the only states to record an increase in dwelling approvals in trend terms, while Tasmania was flat. Now, our surveys revealed that in November there was a rise in mortgage stress again, and so you can see more in our post Mortgage Stress Goes to the Moon, in which we discuss the list of worst hit postcodes. Across Australia, more than 1,015,000 households are estimated now to be in mortgage stress. Last month, 1,008,000. This equates to 30.9% of owner-occupied borrowing households, and in addition, more than 22,500 of these are in severe stress, and we estimate that more than 61,000 households risk 30-day default in the next 12 months. Continued rises in living costs, notably childcare, electricity, school fees and food, whilst real incomes continue to fall and underemployment is causing significant pain. Many are dipping into savings to support their finances. Indeed, significant numbers of households have had their potential borrowing power crimped by lending standards belatedly being tightened and are therefore mortgage prisoners is significant. More than 49% of those seeking assistance to refinance are now having difficulty. This is strongly aligned to those who are registering as stressed. These are households urgently trying to reduce their monthly outgoings. In addition, negative equity is now rearing its head. See our post where we discuss this in detail. Data from APRA, the property exposures figures, showed that banks wrote nearly 26,000 new mortgages with a loan-to-value ratio of more than 90% and a further 51,000 with an LVR of between 80 and 90% in the past year. Now that's 20% of all loans written in the same period. I would expect these numbers to fall significantly as lenders tighten their standards further. But it's also worth remembering that in some cases existing borrowers have pulled more equity out to allow them to pass funds to their kids, the so-called bank of mum and dad. And in the case of a forced sale, the market value may well overstate the true recovery value of the property. And using the property as an ATM just does not work in a falling market. Now, last month, a Roy Morgan survey of 10,000 borrowers found that 8.9% were slipping into negative equity, up from 8% 12 months prior, which would work out at around 386,000 households. Now, we've run our own analysis with data up to the end of November, and on our modelling, there are around 400,000 households across the country in negative equity, both owner-occupied and investors. There are about 3.25 million owner-occupied borrowers and at least 1.25 million investors. So it's around 10% of properties that are currently underwater. And it will only get worse. The property market news continues to highlight the cracks as price continue to ease. And last week, CoreLogic says that 2,749 homes were taken to auction across the combined capital cities, slightly higher than the week prior, when 2,701 auctions took place. But the higher volumes saw the final clearance rates weaken further, with only 41.3% of homes selling at auction, making it the lowest result seen since October 2011. In comparison, this time last year, 3,291 homes went to auction and a clearance rate of 60.3% was recorded. Melbourne's final clearance rate was recorded at 42.7% across 1,378 auctions last week, improving on the 41.4% final clearance rate the previous week across a lower 1,132 auctions. And over the corresponding week last year, 1,647 Melbourne homes were auctioned and a stronger clearance rate was recorded at 65.4%. Sydney's final auction clearance rate came in at 41.6% across 937 auctions last week, falling from 44.8% across a higher 1,035 auctions over the previous week. And over the same week last year, 1,143 homes went to auction and returned a clearance rate of 56.2%. And across the smaller auction markets, clearance rates improved in Perth and Tasmania, while Adelaide, Brisbane and Canberra saw clearance rates fall week on week. And the combined capital cities are expecting to see a lower volume of auctions this week, with CoreLogic currently tracking 2,498 auctions, significantly lower than the 3,371 over the same week last year. Melbourne is set to see volumes fall over the week, with 1,205 auctions being tracked so far, and in Sydney, 840 homes are currently scheduled for auction this week. And across the smaller auction markets, Brisbane is expected to be the only city to see a rise in volumes week on week, with fewer auctions scheduled in Adelaide, Canberra, Perth and Tasmania. Of the non-capital city auction markets, Geelong was the best performing in terms of clearance rates at 46.4%. And more economists are predicting bigger falls in home prices. For example, AMP's Shane Oliver believes there is still plenty of room for property prices to head south as homes weaken to GFC levels. The decline in property prices is being driven by a perfect storm of tighter credit conditions, poor affordability, rising unit supply, reduced foreign demand, the switch from interest-only to principal and interest mortgages for a significant number of borrowers, fears that negative gearing and capital gains tax concessions will be made less favourable if there is a change of government, falling price growth, and expectations and fear of missing out, or FOMO, risking turning into FONGO, fear of not getting out, for investors. He believes the decline in Sydney and Melbourne property prices has much further to go as comprehensive credit reporting kicks in, making it even harder to get multiple mortgages, and many home buyers will be watching out for changes in negative gearing and capital gains tax, which could become the new reality after a change of government and the coming federal election. In these cities, we expect to see a top-to-bottom fall in prices of around 20% spread out to 2020, Mr. Oliver said. However, the plunge in clearance rates and the uncertainty around credit tightening and tax concessions indicate that the risks are on the downside. So there is more to go yet. Yet, still the bulls are roaring. This as reported in news.com.au. Buyer's agent Nick Viner believes now is the time to buy in Sydney and Melbourne, with many discounted premium properties available with minimal competition. This environment is the absolute perfect time to buy because you've got more time to consider your options and there's more choice in terms of available homes, Mr. Viner, principal of Buyers Domain Australia, said. You also have the ability to focus on really blue chip properties in your budget. You can bag a more superior property that you can really only get for cheaper in markets like this. Most economists believe the total property price falls in Sydney will be within the vicinity of 15%, which means some prime suburbs have already bottomed out. Oh yeah? And Domain continues to hype up the first-time buyer opportunity as the Western Australian government announced that it would expand its Key Start loan book by more than $420 million to help stimulate demand in the housing market, saying it's evidence APRA's credit control measures of the past 3 to 4 years and further tightening to come from the Banking Royal Commission has dampened activity across the nation. To respond to this situation, Western Australia will be expanding its Key Start loan to stimulate demand and allow more first-time home buyers the ability to enter the market. More unnatural acts. My message to first-time buyers is simple: hold your fire. Prices have further to drop, and next year you could spend less and get more. And Jonathan Mott from UBS said this week that the banking sector is facing a period of substantial and sustained earnings pressure, which is likely to last several years. The risk of the current credit squeeze turning into a credit crunch is real and rising, with the housing market now falling sharply. Mott added, if the use of the household expenditure measure benchmark is deemed to not meet the requirements of responsible lending, this further increases the risk that the banks face mortgage mis-selling actions. We see this as a significant and large tail risk, which appears to be becoming increasingly likely as home prices fall. And RBA's DeBell addressed home prices in his Q&A session on Thursday, saying that they are watching home prices. From what I can tell, what we haven't seen anywhere in the world is a decent fall in house prices in two capital cities at the same time unemployment is going down and the economy is growing at a reasonable pace. This is uncharted territory. Credit is still flowing, but at a much slower rate, and it's something we are watching, but that is as much a function of banks' willingness to lend and not so much the price. No, RBA, it's simply the reduction in the credit impulse, the rate of credit growth, is sufficient to explain the falls. And no, it's not time to loosen credit standards again. Turning to the local markets, the banks were weaker through the week, though with a small uptick on Friday. The local volatility or fear index was still in risk-on territory, if down 0.23% to 1673. CBA closed at 70.37, up 1%. NAB was at 24, up 0.25%. ANZ was up 0.16% to 25.71, and Westpac was up 0.23% to 25.73. They are all way down on a year ago. Macquarie closed at 113.32, up 1.13%, having been driven lower by the poor global financial news. Regionals fared less well, with the Bank of Queensland down 0.31% to 9.74 as they announced a search for a new CEO as John Sutton resigns. Suncorp was down 0.45% to 13.31 on Friday, and Bendigo and Adelaide Bank slid a little, down 0.09% to 10.61. AMP continues lower, down 3.32% to 2.33, and mortgage insurer Genworth was down 0.85% to 2.34, having moved a little higher earlier in the week. The ASX Financials Index is sitting near recent lows, if up 0.09% on Friday to 5,621.70, and the ASX 100 ended at 4,676.50, up 0.47%, but below the earlier April 2018 dip. Expect more weakness ahead. The Aussie slid 0.48% to 71.99, having been as high as 73 in the week, but the weaker local economic news will likely drive it lower, and we still think mid-60s is possible in the new year. The Aussie Gold Cross was up 1.31% to 1,733.31, and the Aussie Bitcoin Cross was down 6.59% to 4,709.4. And we're going to discuss cryptos more in a moment. Across to the US, where the Dow eased its gains for the year after plunging Friday on a weak jobs report and concerns over the US-China trade tensions. The fear index was higher, up 9.63% to 2323, indicating significant concerns and higher volatility. The Dow Jones Industrial Average fell 2.24% to end at 24,389 and is down 1.34% year to date. The S&P 500 fell 2.33% to 2,633, and the Nasdaq Composite fell 3.05% to 6,969.25. The S&P 100 was also lower, down 2.39% to 1,167.57. And the US-China trade tensions were thrown into further turmoil after President Donald Trump's trade advisor Peter Navarro said if issues with China are not resolved during the 90-day ceasefire, the administration will raise existing tariffs on $200 billion worth of Chinese goods. Tech also contributed meaningfully to the sell-off on Wall Street, led by Apple, which was down 3.57% to 168.49 after Morgan Stanley cut its price target on the tech giant shares on fears over a slowing smartphone market in China. That was the third Apple price cut this week, following cuts by both Rosenblatt and HSBC, sending Apple's shares more than 3% lower. Other tech stocks also fell, with Intel down 4.4% to 46.24, Alphabet or Google down 2.92% to 1,046.58, and Amazon down 4.12% to 1,629.13. The index of financials was 1.84% down to 415.44, well down over the year now, with Goldman Sachs Group down another 2.4% to 179.67. Energy, meanwhile, struggled to take advantage of the rally in oil prices, which had followed an agreement by OPEC and its allies to cut production by 1.2 million barrels a day for the first 6 months of 2019. The oil price was up 1.51% to 52.27. Now we need to look in more detail at cryptos. Bitcoin continued to fall and closed down 90% from its record highs. Virtual currencies have fallen dramatically in recent weeks, with news of regulatory scrutiny and a hard fork in Bitcoin Cash cited as major headwinds for the crypto industry. And cryptocurrencies overall were lower, with the total coin market capitalization of 107 billion US, compared with 120 billion US on Thursday. Bitcoin was down 7.13%, having traded near a session low of 3,377.40 to end at 3,430.8. Meanwhile, the creation of a Bitcoin exchange-traded fund is unlikely anytime soon, said the SEC. Now, I recorded an interview with local crypto expert Alex Saunders from Nuggets News, in which we discuss current trends. And as you will see, he remains positive, and apologies for the quality of the recording, by the way. Today, I'm joined by Alex from Nugget News. Hello, Alex.
How are you going, Martin? Thanks for having me.
Very good to have you on the channel, and thanks very much for spending some time with us. You are just the person I need to talk to at the moment, because Bitcoin is tanking, and I want to know what's going on, but I also want to try and get a little bit below the surface, right? Because, of course, the media just sort of play up the price, but I think there's a lot more interesting conversation to have. So thanks for spending some time with me to explore. So let's just start with the obvious news. Bitcoin price continues to fall. What's driving that?
Well, I'll just introduce myself. I've been into Bitcoin ever since, the GFC, and I went down that path of gold and sound money and so on, and then I found Bitcoin in 2012. So I've been doing this and educating people for 6 years now, and in that time, we've seen somewhere between 6 to 8 corrections between 30 and 90% in magnitude. So the first thing to realize is that Bitcoin is extremely volatile. Similar to penny stocks or any small market when it's first traded, price discovery is very hard, and we don't know how to price these things just yet. Australian government are classing them as property, others are treating them as currency. A lot of people last year treated it as a speculative investment, and it ran from $1,000 to $20,000 very quickly and got overvalued. And now we're seeing that correction. It's coming back to reality, and we're currently at around $3,500 US today.
Yeah, that's more than 70, 80% down from its peak, and but that's the point, really, isn't it? People should be understanding that this is actually a very volatile, somewhat risky sector of the market, but it doesn't mean that it's completely without a foundation, nor indeed does it necessarily not have potential. So we'll touch on that a bit later. But one of the things that I think has created one of the wobbles is this concept of a fork. We had a fork a couple of weeks ago. So can we just explore what a Bitcoin fork actually means?
Yeah, so a fork is a term that is used to upgrade the network or make changes to the network. And Bitcoin has gone through several forks. Some of them are called a soft fork. You can think of that as a software upgrade that's still compatible with previous versions. So just like when you update your phone, it has a few new features, but your phone still works with all its old apps and settings and so on. Whereas the ones that are making the news are these hard forks, where there's a group of people that say, we don't like the direction that Bitcoin is going, we want to do something different. And they can hard fork the network, and what that means is from that point onwards, there's now two blockchains, and they're not compatible anymore. And if you owned Bitcoin at that point in time, you now have Bitcoin and Bitcoin Cash. Or what we saw recently was the Bitcoin Cash community that did a hard fork last year. They split off and did their own little community and things. They actually had infighting within their own fork, and they forked themselves. Now, it starts to get a bit pedantic here, and you're thinking, oh, geez, this is bad for Bitcoin. But the price of both of those coins has dropped significantly, more than half each. So a lot of the things that make Bitcoin great are its network effects and the fact that consensus by the majority of the community is maintained and agreed upon. So in a lot of ways, this actually makes Bitcoin stronger, because we've had about 30 forks. Some of them are tiny, some of them are bigger than others, but they kind of fall by the wayside, and Bitcoin goes on and does its thing and maintains, 90, 95% of the community each time. So, it is a way of, I think of it as making Bitcoin anti-fragile. Anyone can say that they want to make a better version of Bitcoin, but as long as 95% of the people are agreeing that no, there's only one Bitcoin, it makes it stronger.
So to understand that, there is, as I understand it, a theoretical limit to the amount of Bitcoins that can be created ever, right? So if you fork, that doesn't change the total number of Bitcoins, does it?
No, so there can only ever be 21 million Bitcoins, and at the moment we're at about 17 million. So when you do a hard fork, we now have 17 million Bitcoin and 17 million Bitcoin Cash. But that value can't just come out of thin air. So that's what we see, it might have 5% of the value if there's 5% of the community that want to put their money in that coin and think that's the real Bitcoin. So it's not just free money as some people sort of think of it as. Yeah.
Okay, but it doesn't fundamentally change the total count. It just sort of splits it up and separates it just into different pools, as it were.
Yes. Yeah.
Okay, very, very interesting. And of course, there are many other cryptocurrencies other than Bitcoin, and we seem to have a bit of a proliferation of different cryptocurrencies. And it's worth, I think, just underscoring, they're not all the same, are they? They've got different sort of foundations and different philosophies.
This is very confusing for the average person that's trying to get their head around what is cryptocurrency. So Bitcoin started off, and it was a currency. It was trying to replace a payment system, a store of value. We'll touch on all of that later on. And then we saw others try to come in and compete and say, hey, we think we can do digital money as well. Whereas now a lot of the coins aren't trying to be digital money. They're just projects that are using blockchain technology for a variety of things. So the easiest way to understand this is by giving some real world examples. So an Australian company like Power Ledger are trying to disrupt the renewable energy space, and they want to let you sell your solar power to your neighbor. And their software, the computer program that does all this, runs on blockchain technology, and they use a cryptocurrency to do all this. So that's just one example of, hey, they're not really trying to compete with the banks or trying to disrupt the way payments and financial system works, but they still fall under this umbrella term of cryptocurrency, even though they're not really a currency at all. So yes, there's lots out there that are trying to compete with Bitcoin, but there's also the majority of them now that are trying to disrupt individual industries, but unfortunately they're still all called cryptocurrencies. Yeah.
And you've mentioned that very important difference between a Bitcoin and a blockchain, right? The blockchain is the underlying, if you like, technological foundations, which can be applied in multiple instances for multiple purposes.
Yeah, that idea of having a distributed ledger where everyone supports the network. So this is why Bitcoin has never been hacked. There's a big misconception that some websites have been hacked. If you lose your password, you can get hacked. But Bitcoin itself has never been hacked. And that's because you'd have to convince the majority of network participants to change something, just as you do with that hard fork example. As long as the majority of people agree that no, Bitcoin's fine, we don't want to do this proposed change, they are reaching or establishing consensus where all these computers are talking to each other around the world. At any one time, there's between 10 and 15,000 nodes. And as long as the majority of those people are running their computers, Bitcoin can never be hacked. People can't make changes unless it's agreed upon by everyone that, yes, this is what's best for the network.
Okay. And the blockchain technology is something which, of course, could be used in multiple instances. And now what we're beginning to see is an interesting discussion from, for example, central banks about whether they should create a digital currency controlled by the central bank within a blockchain wrapper. And that's in sharp contrast to the distributed ledger approach that we've just been discussing. So I see a bit of tussle ahead between those two philosophies. What do you think?
Yeah, so the point of the blockchain that we just described is that 10,000 people around the world that can be different countries, they're all supporting this network. As soon as a bank creates their own cryptocurrency, you get rid of that decentralized or distributed nature of the ledger, which is what makes it great. So if a bank wants to start a blockchain, there might be the 10 different JP Morgan banks around the world that each run that blockchain. Now, that's not distributed and decentralized. Those 10 banks can be targeted by hackers still. It's no different to their current databases that they use. So, yeah, the idea of Bitcoin and blockchain is giving you sovereignty. You're in control of your money. You're in control of your health data is another fantastic example where doctors may be able to access it, but only with your permission because you have the password. Whereas we see all this health data in these centralized hubs and people might be aware of MyGov. If that gets hacked, and these things are going to have a big target on their back because of how valuable data is to be sold on the dark web these days, if only you have permission to access your data or choose who you give permission to, it's a very powerful concept that everyone's supporting the network, but you have sovereignty over your money, your data. Your voting is another good application. It's fantastic, yeah.
And I guess the argument for central banks thinking potentially of creating a digital currency is that they want to, if you like, regain control of the money supply and effectively impose the old way of thinking onto this new platform.
Yeah, one of the biggest points of Bitcoin as well is that anybody can pay anybody in the world. So it doesn't know any borders. There's no censorship. Whereas if a central bank or a government issues a cryptocurrency, if someone from Russia tries to pay someone else and they don't like that person or they don't like that company, they can freeze that account, they can censor that transaction. That is not what blockchain and cryptocurrency is all about. So it really does lose just about all the defining features if we do have these centrally issued cryptocurrencies. And Venezuela have issued their own called the Petro, and it's kind of like, trust us, it's backed by oil. Trust us, it's backed by gold. Trust us, we won't print more. And, with Bitcoin, you're not trusting a company or a person or a government. You're trusting the entire network and all the participants that want to act in its best interest.
And that's the point. It is philosophically poles apart and, don't necessarily believe what the central banks are saying in terms of, remember, they're coming from a particular worldview, a particular point of control, and that isn't necessarily the only way of thinking about the problem.
Yeah, and people say, well, what's Bitcoin backed by? It's backed by nothing. Well, these days, all fiat currencies are gradually losing value as we see against real assets, or they're not backed by gold anymore. A lot of countries now are already only using digital money. I think it's Sweden or Switzerland is 100% digital now. So what is their money? Well, it's only trusting government that they're not going to print more. Now, look at how that's worked out for Venezuela, Greece when they freeze the ATMs, or, so many instances now where people do not have access to their own money, or if people have worked and saved their whole lives, all their purchasing power has been eroded. And in these countries, we're already seeing 10, 20, 50% of all transactions being done in Bitcoin because it is a better system than their current government-issued money.
Okay, last question, Alex. You're still confident about the future of blockchain and Bitcoin?
I am. As I said, I've sat through 90% corrections in the past, and here we are at 80%, and Bitcoin definitely got euphoric last year and got ahead of itself. I also think what we're seeing for the first time in history is I call them the big boys on Wall Street. The smart money always get in early, whether it's the dot-com bubble, whether it's IPOs, whatever it is. They're normally first to the party. They make money and then they on-sell it to retail investors or whoever else is down the food chain. What we saw last year was retail mum and dad investors get in on the ground level of a lot of these projects before Wall Street had even any idea what they were or an ability to invest in them. And what I really think we're seeing is a lot of ways for people to now short the market and push prices down. And I don't want to put my tinfoil hat on, but I think they are trying to somewhat drive prices down so they can accumulate. We're here that a Bitcoin ETF is on the way. There's another company called Backed that are doing a fully one-to-one backed sort of investment fund or daily futures contract. So all these Wall Street investors, it's a new asset class, and I think just like any diversified portfolio, it is going to be an uncorrelated asset that is attractive to some people. Now, whether that number is 1%, 5%, or 10%, there's a kind of a theme in Bitcoin called get off zero. And as Bitcoin starts to go up in price again, which I definitely think it's going to do in the future, a lot of people are going to demand, hey, I want 1% in my portfolio of Bitcoin. And because there's so few Bitcoins and the total market cap is around 100 billion, it's just, it's minuscule compared to gold or the stock market or other fiat currencies. People are going to see it as a store of value over the longer term compared to something like parking money in the real estate market. Or I just see so many functions that Bitcoin is going to do in the future, and it's very early on. It's still developing.
Thank you, Ray. Alex, I really appreciate your time today, and I think that last message is really important. We're very early in the evolution of where this is going, and people shouldn't write it off, should they?
No, and I just want to say that people do say, how can it ever be a store of value or a currency if it's so volatile? There's trillions of dollars sloshing around in the world every day in fiat money, and we're trying to disrupt that space. So we can't go from this tiny market to a huge market without having big volatility and swings, and it's going to get overpriced and then undervalued, just as we've been through these cycles several times before.
Thank you so much. I really enjoyed talking to you.
Now, my own view is that currently Bitcoin is all but pure speculation, but the potential of blockchain is real. And it will come down to a tussle between central bank controlled cryptos and distributed ledger solutions. It's too soon to judge who will win. Back to the markets, the US dollar was lower on Friday amid worry that the Federal Reserve could pause its hike of rates due to concerns of slowing global growth. In fact, the Wall Street Journal reported on Thursday that the Fed is likely to consider a wait-and-see approach after hiking rate increases at its next meeting in December. The US dollar index, which measures the greenback strength against a basket of 6 major currencies, inched up 0.10% to 96.85. However, on a weekly basis, the dollar was set for the biggest drop in more than 2 months against a basket of its rivals. Falling US yields have also weighed on the dollar, with the benchmark 10-year Treasury yield at 2.854 down 0.74% after dipping overnight to its lowest level since late August. The 3-month was down 0.57% to 2.396, and the inverted yield curve between the 2-year and 10 years suggests more trouble ahead. Gold was stronger, reacting to the market uncertainty, up 0.85% to 1,254.15. And with Brexit still in the mix, the euro-US dollar ended up 0.27% to 1.1409, and the British pound US dollar was down 0.31% to 1.2744. Deutsche Bank ended at 7.719, having broken below 8 this week. And it was up 0.77% on Friday. Many have said that if the bank dropped below that 8 threshold, this would be a significant event. Well, now it's happened, so risk is on. So we conclude that market weakness will continue up to the end of the year, and locally home prices will continue to fall. So to answer my own question, no, we are not there yet. In fact, I suspect we are still in the early stages of the correction which is coming, and 2019 looks like being the year. And by the way, If you value the content we produce, please do consider supporting our efforts. You can make a one-off donation via PayPal, that's a new facility, or consider joining our Patreon program. We really appreciate those who are contributing to help us make great content. The links are in the comments below. And as always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you've already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst of Digital Finance Analytics. Many thanks for watching, and I'll see you next time.